Hello everyone and welcome back to these sessions on financial statement analysis for CFA level 1. Now from this class we are going to start our discussion on long-term assets. Long-term assets which are also referred to as non-current assets. So the traditional way of identifying these assets was long-term assets. Now in the modern terminology we have primarily two categories of assets: current assets and non-current assets. Assets which are expected to be held or consumed within 12 months from the date of their acquisition, these are current assets. Assets which are expected to be used for a period longer than 12 months are non-current assets. So all long-term assets are now termed as non-current assets. Now you will basically find two categories of long-term assets, one which are tangible, another which are intangible. So tangible assets primarily would mean property, plant and equipment. So all your properties, land, building, your plants, machinery, equipments, furniture, all come in the category of property, plant and equipment, which is basically representing tangible assets. Then we have another category of long-term assets or non-current assets titled as intangible assets. Now when we are going into the topic intangible assets, I'll explain to you what exactly is intangible asset, but basically you should have just a simple idea about intangible assets very clear. Intangible assets are assets without any physical form or without any physical substance. This may include some kind of copyrights, patent rights, goodwill of an entity. It may include franchisee rights. Generally, legal rights come under intangible assets because you have right of something. It is your asset and that asset is not having any physical form. So we call it as an intangible asset. I'll give you some more example. Suppose you have a laptop with you, that is a tangible item, but the application softwares that you are using in your computer system, those are intangible items. So how do you distinguish tangible and intangible items? It is very simple. Assets that have physical form are tangible. Assets that do not have a physical form are intangible. Now what CFA Institute has done, they have placed the entire discussion of tangible items under the prerequisite material. So if you have already covered the prerequisite material, then this particular lecture can be just viewed for a quick recap. But if you haven't learnt, then I would suggest you to understand and write down each elements of concepts, because if you are not clear with accounting for tangible items, you will not be able to understand the accounting for intangible assets. So let us begin our discussion with the first category of long-term assets titled as property, plant and equipment. I would want you to write this title in your notebooks and first try to understand what are property, plant and equipments. So property, plant and equipments are first of all tangible items and they are held by the entity with an intention to use. So you may hold assets with an intention to sell. For example, inventories. You are holding inventories with an intention to sell, or some items may not be your inventories. Say you have decided not to use a particular asset because it is either old or not suiting your business, you have decided to keep it for sale. Then these are either inventories or non-current assets held for sale. So non-current assets held for sale are also tangible items, but they don't come under this category of property, plant and equipment. That is why property, plant and equipment has been defined as tangible items which are held for use. Now held for use, which type of use? These may be for production and sale of the product and services that the entity is providing. For example, if my company produces and sells these kind of calculators, then for production and sale of this kind of calculator, whatever tangible items or tangible assets I am holding will come under property, plant and equipment. So they are held for production and sale of products or services which are supplied by the entity, or they could be held for rental to others. Correct? There may be assets which are held for giving it on rental basis to others. Even these are your property, plant and equipment. Correct? Third purpose of holding these assets could be administrative purpose. For example, the computer systems that I use in my recording and editing work are required for the production and supply of goods or services that I am providing. On the other side, the computer systems which is used by my backend staff who are basically just doing administration activity. Now those computer systems are not directly involved in the production process, they are performing administrative work. So when I say held for use, it could be three types of use. It could be used for production and sale of goods or services. It could be held for use by others on rental basis, or it could be held for administrative purposes. But most important feature of a property, plant and equipment definition is it is held for use and it is intended to be used for a period longer than 1 year. If it is intended to be used for a period within 1 year, you cannot put it in the category of property, plant and equipment. Precisely, it will not be then treated as a non-current asset itself. It will become a current asset if it is intended to be used within a period of 1 year. In that case, it is not a kind of asset which is a long-term asset. It is more of a consumable thing, what you are purchasing and you are consuming within 1 year. Then it will not come in the category of property, plant and equipment. So for better understanding, I'll put that definition of property, plant and equipment on screen. Please try to understand this definition. Property, plant and equipment. These are tangible items which are held for use for three different purposes: in production or supply of goods or services, for rental to others, or for administrative purposes. And most importantly, as I said at the end, expected to be used during more than one period. One period here necessarily means one accounting period, that is 1 year. So if any kind of tangible item which is held for use and used intended for a period longer than 1 year, then it will come in the category of property, plant and equipment. Let me give you a chance to write down these notes quickly. Alright friends, once you have completed writing this much, let us move ahead and continue further. Recognition. Now what is meant by recognition? See, first time when you are bringing any accounting item in your accounting records, we call that as recognition. How do you recognize something, whether it is asset, liability, income, expense, gain, loss, anything? Recognition means bringing it as an entry in your accounting records. In the earlier classes, we have talked about revenue recognition. When should you recognize your revenue? Expense recognition. When should you recognize your expense? Recognition means bringing it into your accounting records. So likewise, when can you recognize and how can you recognize the item of property, plant and equipment in your accounting records? So recognition is not just that you have purchased an asset and you recognize it. It needs to fulfill certain criteria to be considered as an item of property, plant and equipment in your accounting records. So the cost of an item of property, plant and equipment should be recognized as an asset if and only if, look into the conditions, it is probable that future economic benefits associated with the item will flow to the enterprise and the cost of the item can be measured reliably. So you need to understand one thing. What is to be recognized? The cost of an item of property, plant and equipment can be recognized as an asset only on fulfillment of both of these conditions. What is worth noting, if you can look at the screen, this word and mentioned between the two conditions A and B, the word and indicates that both the conditions are supposed to be fulfilled before you recognize an item as an asset in your accounting records. Particularly, I am talking about an item of property, plant and equipment. It can be recognized as an asset only when it fulfills these two conditions. So condition number 1, see, it is supposed to provide you future economic benefits, correct? Let me give you an example for clear understanding. Suppose I say that I have a property and the legal title of that property I can pass on to you. Okay, I am putting that property in your name, but the transfer deed for that property indicates that this property cannot be used by you. This property must be given on rental basis. Fine. The rent collected from the property must be passed on to such and such entity. You cannot keep a penny of that rent in your pocket. All the expenses relating to that property maintenance, like property taxes, etc., you will be having some arrangement to get reimbursement of those expenses. That's all. Now, you tell me, even though the legal title of that property is in your name, do you have any economic benefit that will ever accrue to you? The answer is no. In that case, see, accounting requires one thing very clearly. If you are identifying something as your asset, it must give you economic benefits. So the first condition is future economic benefits should flow to the enterprise. And the second condition over here, because you are going to measure this item at cost, the cost can be measured reliably. There should not be any ambiguity in measurement of cost. So you need to have fulfillment of both of these conditions, and then only you can recognize an item of property, plant and equipment in your accounting records. So what will be the measurement at recognition? As I told you already, it should be measured at cost. So an item of property, plant and equipment that qualifies for recognition as an asset should be measured at its cost. Alright friends, once you have completed writing this much, let us move ahead and continue writing further. Elements of cost. The cost of an item of PPE. PPE can be used as short form for property, plant and equipment. Comprises its purchase price, including import duties and non-refundable purchase taxes after deducting trade discounts and rebates, any costs directly attributable to bringing the asset to the location and condition necessary for it to be capable of operating, initial estimate of cost towards decommissioning, restoration and similar liabilities, and capitalization of borrowing costs. Now before you write up this whole thing, let me give you the precise explanation required for what is to be included within cost. When we say that you should be able to measure the cost reliably, but what should be included in the cost? Let us crack it one by one. The first clause over here, A, indicates the purchase price. Of course, if you have purchased an item of property, plant and equipment, its purchase price is the part of the cost. Then, including import duties. Now, of course, if you have purchased an item of property, plant and equipment from outside your country for you it is an import, and as per the regulation of your country, you will have to pay some kind of import duties on that. So import duties will be part of the initial cost. Then non-refundable purchase taxes. Now we have generally a system of indirect taxes which is known as VAT, value added tax. In certain countries like India, it is GST, goods and service tax. So basically, if I have purchased an item of asset and I have paid GST or VAT on that, and if I am using it in my business, that business generates revenue for me, and on that revenue I have to collect GST or VAT from the customer, then I will have a tax payable to the government, correct? I will collect and pay it to government. But there is a system of input credit. If I have paid VAT while making a purchase and I am liable to pay the VAT that I have collected from my customer, I can offset these two and the net amount only I should pay to the government. That means that tax which I have paid while I have acquired an asset, that tax I have paid from my pocket, but I will kind of recover it, or I will get a refund of it while setting off against my VAT liability. In that case, such component of purchase tax is a refundable purchase tax. Then it should not be included in the part of cost of PPE. But if it is non-refundable under any circumstances, then it should be included as part of the cost. So you should include the purchase price, you should include the import duties, purchase taxes which are non-refundable, and of course while making the purchase, if the supplier of the equipment or machinery, whatever you have purchased, has offered some trade discount or rebate, it should be subtracted from the purchase price to arrive at your cost. It is very simple and logical, right? What you are adding, what you are not adding, you should be very clear. What you are subtracting from the cost to arrive at the cost, you should be very, very clear with that. Second part, B clause, it says any cost which is directly attributable. See, you are purchasing a machinery, but that machinery, just after purchasing it is not enough. You have to carry out the entire installation process. Now, installation of a big machinery may take a lot of effort, time and cost. Any cost which is directly attributable to installation of such machine, until it is ready to be operated or ready to be used or ready for its intended use, all the cost what you are incurring should be included as the initial cost in that property, plant or equipment, or in my example in that particular machinery. So any cost that is directly attributable to bringing the asset to the location, even bringing the asset to the location means if there is any transportation cost involved, it will be included as part of the cost. Any cost which is incurred for bringing the asset into a condition which is necessary for it to operate, that means all installation, fitting, all kind of initial cost will be part of the cost of that property, plant and equipment. Now third component over here is little dicey, you need to understand it very well. Suppose you are planning to install an oil rig for extraction of oil. Extraction of oil from the surface or beneath the surface of the earth is not something that you can just do like that. You need to seek permission from your government. Now, even though the land is occupied by you, if you want to extract oil from within that land, you need to ask permission. If there is an oil deposit on the or beneath the surface of a seabed and you are installing an oil rig for extraction of oil from there, you cannot do it just like that. You need to take approval. That approval when you get, that license when you get, that permission when you get, it will be a conditional permission. That boss, today you are installing an oil rig on the seabed. After the oil extraction process is completed, you cannot keep that equipment just like that. You need to remove it and you need to restore the seabed. For such restoration, you will incur cost. For such removal of equipment, you will incur cost. That cost may be incurred after 10 years from now. But whatever cost you are incurring at that time, the present value of that cost should be included in your initial cost. Now this is something very, very important which many people do not understand, but it is very logical that the objective of bringing that machine is to use it for the purpose of extraction of oil. Therefore, the day when you are going to remove it and you are going to incur the cost, that cost will be incurred later on, but the present value of that should be subtracted from the initial cost to arrive at the net cost which will be recognized in your accounting records. Coming to the last part, that is D, which is talking about capitalization of borrowing cost. What we are going to do, we are going to understand the capitalization of borrowing cost later in detail. In fact, even with income statement analysis, I have talked a bit about capitalization of borrowing cost. So basically, when you are acquiring an asset and the funds that were required for acquiring that asset were borrowed funds and you have paid interest on that, you are paying interest on that. If the asset is ready for its intended use, you can charge the interest cost to your income statement as expense. But if the asset is not ready for its intended use, the asset is still under construction and it is funded by borrowings, then the asset is not generating any income or benefit for you. So no cost of borrowing should be charged to income statement. Such borrowing cost should be capitalized. So capitalization of borrowing cost is also one of the component of initial cost. So please write up these components and then I take you ahead. Alright friends, once you have completed writing this whole thing, let us move ahead and summarize what you have written. Cost of PPE will be its purchase price plus import duties plus non-refundable purchase taxes minus trade discounts and rebates plus directly attributable costs plus decommissioning, restoration and other liabilities. This point needs to be added not at its original estimate but at the present value, because these costs you are going to incur not now but on termination of the asset. And lastly, we have capitalization of borrowing cost, if any. So this is just the summary of what you have written, but I will prefer that you write this as well so that you are crystal clear with what should be included in the cost of PPE. Alright friends, once you have completed writing this whole thing, let us move ahead and continue further. Examples of directly attributable costs: cost of employee benefits, professional fees and site preparation, initial delivery, handling, installation and assembly costs, cost of testing after deducting the net proceeds from selling any samples produced during testing. So let me explain this to you before you write. See, you would have purchased a machinery and you are in the process of installing that machinery. If you have paid salary to your own staff who have dedicated their time and effort for installation purposes, then the salaries, wages, any kind of employee benefits that you have incurred for the purpose of installation of that machinery should be included as part of the initial cost. It will be part of the directly attributable cost. Any kind of professional fees that you have paid to any expert, say an engineer who is specifically performing this operation just for installation purposes, so any professional fee you pay to that engineer will be part of the initial cost. Site preparation: see, when you are installing a big heavy machinery at a particular site, you need to keep the site also prepared for operation of that machine. Maybe you have to construct long walls. So construction of those long walls around the machinery will also be part of the cost of that machinery that is constructed not as a building or a separate equipment. It was for the purpose of supporting the operation of that equipment. Initial delivery, handling and installation cost and assembly cost also will be part of the initial cost of the asset. And cost of testing. Now see what happens when you install a new machine, you would want to carry out a trial run. So even when you are spending something on testing, you are incurring that cost, even that will be part of the initial cost. But during the trial run, if you have obtained some products, this is not your usual sale that you recognize as revenue. Whatever revenue you have obtained on sale of such products during the production trial run, that revenue should be subtracted from the cost that you have incurred during the trial run, and then the net cost of trial run should be included in your initial cost. So quickly write up these pointers and then I take you ahead. Alright friends, once you have completed writing this much, let us move ahead and continue further. Costs that are not included. Cost of opening a new facility or business, for example, inauguration cost. Now, if you already are operating at some place and now you have started a new branch, the branch will have its own assets like building, furniture, some machineries, equipments, etc. You have purchased, all that will be cost of your asset. But if you are performing any inauguration ceremony and what you are incurring as inaugural cost, that is not to be included in your property, plant and equipment. Cost of introducing a new product or service, including the cost of advertising and promotional activities. So if you are coming up with a new product and for that you have incurred promotional expenditure, advertisement expenditure, it is not to be included as part of your cost of PPE. Cost of conducting a business in a new location with a new class of customer, including the cost of staff training. See, when you are incurring cost on staff training, you are adding value not of your assets, you are adding value to your employees, and your employees are not your property which can be identified in the balance sheet. So keep in mind one thing, not just over here, even when we are learning intangible assets. See, with tangible assets it may be still very clear, but with intangible asset it may be asked to you as a question. You have incurred heavy amount of expenditure, say $80,000 in conducting a program which is meant for staff training, and after completion of the program your staff is well educated and well trained to perform operations which they were earlier not capable of. That means this training has added value and now you are able to generate good economic benefits because of the better learning and efficiency of the staff. Should this training cost be recognized as an intangible asset? The answer would always be no. Keep in mind one thing, your asset which you are putting in your balance sheet, the primary definition of asset is what? It is something which is in your control. When you talk about your staff, if you have trained your staff, it is adding value to your business only to the extent they are working in your company. The day your staff is leaving, the skill that was developed will go along with the staff, correct? So keep in mind one thing, you have no control over how long that employee of yours will work with you. You have absolutely no control over that. So when you are spending something on your employee, it is the employee's value which is rising up, not any asset that belongs to you has increase in value, and therefore staff training cost should not be included, whether it is any tangible asset that you are talking of or intangible asset. Any kind of staff training or any kind of welfare expenditure carried out on staff which may increase their efficiency, productivity, because of which the revenue generation of the organization will also enhance. It is a fact, and you may establish a direct nexus between that expenditure and the outcome of that expenditure in terms of increased revenue. In spite of all that, you are not supposed to include that in any asset, because this is not an asset of yours. It is just a benefit that you are deriving because of better efficiency of your staff, and to create that efficiency you have incurred that expenditure. All that is fine, but the fundamental definition of asset is something which is in your control is missing out over here, and that is the reason you should not include such costs as part of your initial cost of asset, whether it is tangible or intangible. So write up further: administration and other general overheads, cost incurred while an item is yet to be brought into use. So you have incurred some cost while an item has yet to be brought into use, that cannot be included in the cost. Cost of reallocating or reorganizing the operations, initial operating losses and the cost of abnormal wastages, all these components of cost cannot be included as part of the initial cost of property, plant and equipment. Let us move ahead and continue further. Now we are talking about depreciation. Now whenever you are having any item of property, plant and equipment, these are your assets where the only exception is land, which is a non-depreciable asset. All other assets are depreciable asset. So property, when I say property, if it is a building, it is a depreciable asset. If it is a land, it is a non-depreciable asset. So any depreciable asset will have a finite life, correct? Because an asset cannot have an infinite life. Land is the only exception. So buildings, property in the form of buildings or any structures, machineries, plants, equipments, furniture, all these are tangible items which will have a definite life or useful economic life. At one point that life will be over. What you need to do? Apply the matching concept. The matching principle or the matching concept conveys one thing very clearly. If you have acquired an item of property, plant and equipment and its life is going to be 8 years as per your estimate, the initial cost what you have measured should be systematically amortized over these 8 years period, and this should be done by charging depreciation. So that annual amortization of that cost is what we call as depreciation. Depreciation basically is referred to as a charge arising on you because of regular wear and tear or usage of your property, plant and equipment. So for example, if you have acquired an asset costing say $80,000 and its life is 8 years, you are going to amortize that $80,000 over 8 years. What should be the pattern of that amortization? That depends on in what manner you are finding the benefits of that asset. Now this could be a straight line approach or it could be a written down value approach. It may have different aspects. We are going to learn that separately when we typically talk about depreciation methods. But right now our focus point is to understand what will be the impact of this depreciation on your property, plant and equipment. Your property, plant and equipment initially recognized at cost, subsequently it will be measured at cost less depreciation. That cost less depreciation is what we call as written down value. So WDV, written down value, will be the value that will be stated in your balance sheet. Now with respect to depreciation, how to charge depreciation and in what manner you should charge depreciation, it is something very, very important. Now in the traditional accounting, we had one straight way of charging depreciation at a specified rate depending upon the useful life of the asset. But now imagine that you have purchased an aircraft. The engine of the aircraft may have a different life compared to the rest of the body of the aircraft. For making much smaller example, when I use a projector in my classroom for display of such content on screen, the life of the projector could be say 10 years, but the lamp which is used in that projector, the life of the lamp is hardly 1.5 years, nothing beyond that. So that lamp in the projector is an important component of that asset. Life of that is different from the life of the projector. So each component which is a major part of that asset should be depreciated separately. So for example, if I say that lamp life is 2 years, projector life is 10 years, then what I'll do is, whatever be the initial cost incurred for purchasing the projector, including the lamp which was there fitted when I purchased the new projector, what will be the market price of that lamp standalone and rest of the projector, I have to split that, and the lamp will be depreciated over a period of 2 years, whereas the projector will be depreciated over a period of 10 years. That precisely is the objective of charging depreciation, and we call this approach as component approach of charging depreciation. So each component will be subject to depreciation. Now you need to understand that the component that we are talking about should be a major component. You cannot say one small tool which was used will have different life. That small tool will be a maybe small spare part. It can be just treated as a spare part lying with you as your inventory or lying with you as your property, plant and equipment, but not as a major component. It is just a spare part. So you should be very clear that component approach of depreciation, when you are applying, and you are applying it on different components of assets separately, each component should reflect a major part. So let us write some notes on depreciation. Under the heading depreciation, you please start writing each part of an item of property, plant and equipment with a cost that is significant in relation to the total cost of the item should be depreciated separately. The depreciation charge for each period should be recognized in the income statement unless it is included in the carrying amount of another asset. Now let me explain this second pointer to you, which is very, very important. See, one side you are reducing the value of your asset by charging depreciation, and the depreciation charge, what will you do with that second effect of the depreciation charge? It will be recognized as an expense in your income statement. But if it is a depreciation of machine and the machine is responsible for carrying out production of this kind of inventory, I am making this kind of remote controls in my factory. So the machinery that is involved in production process of this, the depreciation charge will be allocated to each unit produced, and that will become the part of cost of inventory of this particular product. In that case, this is an exception to the fact that depreciation will be charged in the income statement. This time the depreciation is included in the cost of the item. So if this item is sold, then as part of cost of goods sold, the expense will be recognized. But if it remains unsold and lying with you as an inventory, it will be stated in your balance sheet as an inventory. It will be your asset unless it is sold. So keep that thing in mind and continue writing further. The third point over here, the depreciable amount of an asset should be allocated on a systematic basis over its useful life. Let us move ahead and continue further. The residual value and the useful life of an asset shall be reviewed at least at each financial year end. If expectations differ from the previous estimates, the changes shall be accounted for as a change in an accounting estimate. Now carefully understand this point. See, how are you going to charge depreciation? You are going to make an estimate of what will be the useful life of that asset, and accordingly on annual basis you will be charging depreciation. Now suppose at the time of purchasing a machinery, you have estimated that its life will be 10 years. Do you think actually the life is going to be exactly 10 years? Sometimes it may be having lesser fluctuation. Instead of 10 years, it may be 9 years or 11 years or 12 years. Fine. But what if there is a change in the technology, that your old technology asset becomes obsolete? In that case, don't you agree that there will be a change in your estimate? Suppose initially where you have estimated the life to be 10 years, after that initial estimate, just after 2 years, when the remaining life should have been 8 years, you come to know that now this machine will last only for next 3 years. That means you are changing your estimate of life. Accordingly, the depreciation charge will be affected. And now you have to depreciate it within shorter period of time instead of 10 years. Now this is considered as a change in accounting estimate and will be accounted for just as a change in accounting estimate. Continuing further, how about depreciation method? See, the depreciation method that you consider is dependent on the pattern in which the asset is generating economic benefit for you. If the life of the asset is 10 years and over the period of 10 years, it is going to generate economic benefits for you exactly at the same level, then you may simply allocate the cost of that asset over its useful life equally, which we call as a straight line method. But if the pattern is different, for example, initial years the asset is giving you bigger benefit and gradually the benefit gets lower and lower, then you may follow another method of depreciation, something like written down value method, where every year the depreciation charge keeps on reducing because the benefit that is obtained from the use of asset is also diminishing. So if the benefit from the asset is constant, depreciation charge should be constant. If the benefit is in diminishing pattern, the depreciation should also be in the diminishing pattern. In simple words, the depreciation pattern that you consider is completely dependent on the estimate of the pattern in which you are going to draw economic benefits from the asset. So please write up this whole thing and then I take you ahead. Alright friends, once you have completed writing this whole thing, I'm sure you understood that the depreciation is to be charged based on the pattern of economic benefits that you draw from the usage of the asset. Can that change? Yes, it can change, because you estimated that you will be generating the benefits in this pattern, but the actual pattern may differ and you would want to change in the pattern of depreciation now. Again, this change can be done and this will be treated again as a change in accounting estimate and will be accounted for accordingly. So let us write that note as well. You have written this much already. Moving forward, you please write: the depreciation method applied to an asset should be reviewed at least at each financial year end, and if there has been a significant change in the expected pattern of consumption of the future economic benefits embodied in the asset, the method should be changed to reflect the changed pattern. Such a change should be accounted for as a change in an accounting estimate. Please write up this much and then I take you ahead. Alright friends, once you have completed writing this whole thing, let us move ahead. And now we talk about subsequent measurement. First of all, what do we infer from subsequent measurement? See, when we initially talked about initial measurement, at the time of recognition, the initial measurement will be at cost. How to determine that cost? We have talked about that. But subsequently, year on year basis, what value of that asset will be reflected in the balance sheet? That is what we call as subsequent measurement. So while explaining to you the depreciation part, I already told one thing, that from the cost you subtract the depreciation, you arrive at the written down value, and it is the written down value that will be reflected in the balance sheet. There is one more thing that you need to understand over here. Apart from depreciation, there is one more substance that you need to subtract from the cost, and that is basically impairment losses. Now, what are impairment losses? See, sometimes there may be a sudden decline in the value of the asset, which cannot be construed as depreciation, because depreciation is a regular charge, correct? It's a systematic regular charge which arises because of the usage of the asset. What if there is an accident, an event that has caused an accident, and the asset's value has reduced significantly? Say there was a fire, there was some kind of accident. There could be a sudden change in the technology. There could be a sudden change in the market, because of which the asset's value substantially reduces. This is a one-time impact which is bringing down the value of the asset significantly. This is called impairment of an asset. That means the asset has lost its value other than depreciation on a sudden basis. This impairment is a loss, and that should also be reduced from the cost. So from the original cost of the asset, you are going to subtract two things: the accumulated depreciation and the accumulated impairment loss. Two things you are going to subtract: accumulated depreciation and accumulated impairment loss. Once you subtract these two, whatever you land up at will be the written down value of the asset that will be reflected in the balance sheet. However, what I just explained to you is one of the approaches for subsequent measurement, which is identified as the cost model, where the base of the carrying amount of the asset is the cost. There may be a possibility of another model which we call as revaluation model. Now, what is this revaluation model? Revaluation model is basically a model which allows you to consider the carrying amount of your asset which resembles its fair value, which has nothing to do with cost and depreciation, but whatever be the value of the asset in the market, you measure the asset at that value. So sometimes the value may increase, sometimes the value may drop. If the value drops, we better call it as impairment. But what if the value is rising up and you would want to state the value of the asset at that increased value? This is called revaluation. You are allowed to revalue your asset, provided at the inception, when you acquire the item of property, plant and equipment, you have to decide one thing: then are you going to follow the cost model on that or revaluation model on that? And accordingly, based on the model that you select, the subsequent measurement will be carried out. Now, changing from cost model to revaluation model is a change in an accounting policy, because here you were given a choice. You will not consider the change from cost model to revaluation model as a change in accounting estimate. It will be a change in accounting policy and should be, accounted for accordingly. But most cases, entities don't change this kind of policy. They either follow cost model or revaluation model, and this applies for the entire class of the asset. For example, if you are talking about buildings, then all buildings will have similar class. You cannot say that building A I will follow cost model and building B I will follow revaluation model. You cannot do that. However, say you have office building and factory building, then the nature of the two assets are different, then you may follow different models for the two. So choice has to be made at the early stage depending upon what would reflect the best outcome. For example, if I have land as my property, logically on land there will be no depreciation charged, correct? And value of land doesn't depreciate. With the increasing population, the demand for land rises and the supply of land being limited, it is the value of land that will always appreciate. It is a simple common sense, correct? Therefore, for an asset like land, you may prefer following a revaluation model, whereas for assets like machinery, you may follow cost model. You can choose cost model or revaluation model based on what is your perception about how would you want to measure the asset subsequently. Based on your objective, you are allowed to make a choice of any one. So, for the sake of convenience, if there is an asset which you never want to sell, you just want to use that asset till end of its life, best thing would be cost model because it is less complicated. But if there is an asset which you are open for selling it even when it is partly used, then you may follow a revaluation model. For example, suppose I follow a tendency of buying imported cars, using it for a couple of years and selling those imported cars locally as pre-owned cars or second-hand cars. But these are imported cars that I am talking about. I may perform some modification and then sell it. I may perform some changes in the asset and then sell it. In that case, my objective is to use as well as I am open for selling those assets. In that case, what will happen? The changes in the market value of that asset will also reflect the value that I am going to realize from sale of that asset. Therefore, when we are dealing with such assets, we may want to follow revaluation model, which would be a better approach because your objective in accounting ultimately is to present true and fair view, correct? Presenting true and fair view. If there is a change in the fair value of an asset which is impacting you, you should definitely account for it. But imagine you have purchased a machinery and you know that from the beginning of its life till end of its life, you have no intention to sell it. You are just going to use that machine. In that case, it is always preferred for you to follow the cost model because then the change in the market price of that machine is not impacting you. Unless there is an impact of impairment, then it is not a choice. Impairment is a mandate. Impairment loss you have to recognize if it arises. But following cost model or revaluation model is your choice. Revaluation model is generally followed by entities for such assets for which they are open to sale also. Then and then only the changes in the market value is impacting you. Otherwise, change in the market value doesn't impact. For example, you have purchased a house property for your residence. That singular house property, you have decided that you are going to stay in that house property as long as possible. You don't have any intention to sell that house. In that case, if the value of that property rises or falls, does it affect you? The answer is no, it doesn't affect. But what if you have purchased a house property with an investment perspective, that you have purchased it, you would keep it as an investment property with you over a period, and when you get a good value of that, you will sell it. In that case, the changes in the fair value will affect your accounting records. So based on the purpose for which you have acquired an asset, based on your objective, how long you want to use it and how you want to dispose of that asset, you pick either the cost model or revaluation model. That is something important. So let us do one thing. Let us write up some notes on subsequent measurement. Under the heading subsequent measurement, that is the measurement after recognition, an enterprise shall choose either the cost model or the revaluation model as its accounting policy and shall apply that policy to entire class of PPE. So as per the cost model, which is very simple to apply, what you need to do, after recognition as an asset, an item of property, plant and equipment should be carried at its cost, less any accumulated depreciation and any accumulated impairment loss. So please write up this whole thing and then I take you ahead. Alright friends, once you have completed writing this much, let us move ahead and continue writing further about revaluation model. After recognition as an asset, an item of property, plant and equipment whose fair value can be measured reliably should be carried at a revalued amount, being its fair value at the date of revaluation less any subsequent accumulated depreciation and subsequent accumulated impairment losses. I am going to explain to you this part in detail after a while. Revaluations should be made with sufficient regularity to ensure that the carrying amount does not differ materially from that which should be determined using fair value at the balance sheet date. Please write up this much and then I am going to explain to you the revaluation model in little more details. Alright friends, once you have completed writing this much, let us move ahead and continue further. Carrying amount as per cost model. This is very simple. The original cost should be subtracted by the amount of accumulated depreciation and accumulated impairment losses, and then what you get is the carrying amount of the asset which reflects its written down value. But the carrying amount as per the revaluation model, this is the part where I have to offer some detailed explanation. So it will be the fair value on the date of revaluation less subsequent depreciation less subsequent impairment loss, and then you land up at the carrying amount of the asset. Now as I said, there is no need for any added explanation on the cost model, but it is the revaluation model that I need to explain to you in detail. So please write up this thing first and then I offer the required explanation. Alright friends, I am sure you have completed writing this whole thing. Now time for us to understand something about revaluation model in little more details. See, when it was a cost model that you follow, you start with the original cost of the asset, that is the initial cost at the time of recognition what you have identified. From that you subtract two elements, accumulated depreciation up to the reporting date and the accumulated amount of impairment loss if any. Subtract these two from the original cost to arrive at the carrying amount of that property, plant and equipment. What if you are following the revaluation model? Say as on a particular reporting date, say at end of the year 2024, you have revalued your property, plant and equipment. So as at the end of 2024, you will reflect the revalued amount. But when you come to the next year end, that is end of 2025, is it necessary that you will again revalue? What if the frequency of revaluation is not every year? Then your last revalued amount was end of 2024, but you are now reporting the asset at end of 2025. So all the depreciation and impairment losses prior to 2024 end are irrelevant, but the subsequent depreciation and subsequent impairment losses you need to consider. That needs to be subtracted from the previous revalued amount that was arrived at on end of 2024. So that subsequent depreciation and subsequent impairment loss should be subtracted from the value of 2024 year end to reflect the carrying amount at the year end 2025. Now, you have understood one thing very clearly, that it all depends upon the frequency of revaluation. What if the frequency of revaluation is every year? Then every year when you are preparing your balance sheet, you make a revaluation, you make a fresh valuation of that asset, put the new value, so there is no question of depreciation and impairment loss that needs to be subtracted, because you have made the revaluation of the asset on the balance sheet date once again. Now, this again put focus on the frequency of revaluation. Should the revaluation be made every year or once in few years? Now, this cannot be your choice. See, revaluation should be made frequently, but that doesn't mean that every year you have to do it. There may be two possibilities. One, the market of that asset is highly volatile. Number two, the market of that asset is not highly volatile. When the market of that asset is highly volatile, that means changes are going to frequently happen, then it is recommended that you make the revaluation every year end. Then there is no question of any subsequent depreciation or impairment loss that will arise, because at every reporting date you are making a fresh valuation. So that value you have to put in your balance sheet, matter ends. But if the market of that asset is not highly volatile, then the suggested frequency of revaluation should be once in every 3 or 5 years. So if you have chosen the policy of making revaluation once in every 3 years because the asset market is not highly volatile, so at the end of 2024 you made a fresh valuation. At the end of 2025 you are not going to make a fresh valuation. So the previous revalued amount was on 24 year end, that is 2024 year end. From that you subtract the subsequent depreciation and impairment losses to put it as a reporting date of year end 2025. Same thing you will do at 2026. But when you arrive at 2027, it's like 3 years gap. You would now want to revalue your asset. When you say that you have decided to revalue your asset once in every 3 years, it is not a mandate that after every 3 years you must revalue. The objective is very clear. Objective is you observe one thing, the carrying amount and the fair value of the asset. If it is not having significant difference, whatever you are reporting, that is okay. You don't have a need to make a revaluation. But when there is a substantial difference, then you need to make a revaluation. Likewise, say you have decided that you will revalue your asset once in every 3 years. But after 2 years ended, you find that there is a substantial gap between the carrying amount and the fair value, and you decide that at second year end itself you would want to again revalue your asset. Nobody is stopping you. See, it is your asset that you are reflecting in your balance sheet. You decided to apply revaluation model because the asset is not having a volatile market. You have decided to revalue once in every 3 years. But instead of 3 years, if you are revaluing at interval of 4 years or 2 years, it does not matter. What matters is what you are reporting as per revaluation model should reflect the proper value of that asset as on that date. All these complications won't arise if you are reporting your assets at cost model. That is why, while selecting which accounting policy you should follow, the cost model or the revaluation model, I would say you follow the model which is giving the true reflection. So, if you have decided to use the asset for its entire lifespan, you don't have to follow revaluation model. It's better not to follow revaluation model. Why to enter into accounting complications? But where your intention could be that you would want to sell the asset when you get a good price, then the market value of that asset is having some impact upon you. Then you better follow revaluation model. You decide which model you have to follow at the beginning when you have acquired that asset. But keep in mind one thing, the model that you follow is not to be followed just for that individual asset, for the entire class of the asset. You have to follow the same policy. So, I am sure you have written this whole thing. Let us move ahead. Frequency of revaluation. When the fair value of a revalued asset differs materially from its carrying amount, a further revaluation is required. Some items of property, plant and equipment experience significant and volatile changes in fair value, thus necessitating annual revaluation. For items of property, plant and equipment with only insignificant changes in fair value, it may be necessary to revalue the item only every 3 or 5 years. So please write up this much and then I take you ahead. Alright friends, once we have completed writing this much, let us move ahead and continue further. We are talking about effect of revaluation. Now this is something very, very important. When you revalue your asset and if the value goes up, it's a revaluation surplus. This is not an item to be recognized as gain in your profit and loss statement, because you have not realized this gain. It is just a valuation change in your accounting records. So if there is an upward revaluation and it results into a revaluation surplus, it cannot be identified as a gain in your income statement. You may recognize this as a revaluation surplus via statement of other comprehensive income and accumulate this in a kind of reserve called revaluation reserve. However, if there is a downward revaluation, then what you need to do, you need to charge that loss arising on revaluation directly in the statement of profit or loss. So downward revaluation, you are putting it as a loss, because I would simply say a downward revaluation is as good as impairment. So what reflection you give for impairment losses, you give for downward revaluation. Upward revaluation is giving you a gain in value. Unless you have realized that gain in value, prudence in accounting prohibits you to recognize that as a gain until you have realized that. So you better put it in a revaluation reserve via the statement of other comprehensive income. It should not be taken via income statement. Your usual profit and loss statement should not come into picture. So first time when you are making a revaluation, and if the revaluation is downward, put that charge on your income statement. First time you are making revaluation, if the revaluation is an upward revaluation, there is a revaluation surplus that is arising. That surplus should not be recognized as a gain in your income statement. It should be accumulated in a revaluation reserve through the statement of other comprehensive income. However, the matter can become a little complicated when the revaluation is carried out later stages and the revaluation type changes. For example, earlier you made upward valuation, now you are making a downward valuation. Earlier when you made upward valuation, there was a revaluation surplus which you have accumulated in revaluation reserve. Now you are making downward valuation, which will indicate a loss. But loss, to the extent that revaluation reserve is already existing, you don't charge that loss in the income statement. You charge that loss against that revaluation reserve. Excess loss, if any, should be charged to your income statement. Let me explain this to you through an example. For simplicity in understanding, I'll give you example of non-depreciable assets. Say it is case of land. You bought a piece of land at say 40,000 US dollars. After a year, you find that the value of that land has risen to $50,000. So you made a change in the value, upward valuation, from $40,000 to $50,000. $10,000 of gain, what you have made, was not recognized in your income statement as a gain, but was accumulated in a revaluation reserve through the statement of other comprehensive income. In your balance sheet, that reserve is lying as part of your equity ownership, that is, your part of ordinary shareholders' funds. Now, at a later stage the same land was valued downward, and now its revised value is say 38,000 US dollars. Now, earlier from 40,000 to 50,000, the 10,000 revaluation surplus was accumulated and lying in revaluation reserve. Now you have made a downward revaluation from 50,000 US dollars to 38,000 US dollars. What will happen? There is a downward revaluation by $12,000. This downward valuation by $12,000 is a loss. Are you going to put that entire $12,000 as loss in your income statement? The answer is no. Logically, when you made a downward revaluation of 12,000, accounting says that you consider this as reversal of the initial upward revaluation to the extent of $10,000, and the excess downward revaluation beyond that $10,000, that is $2,000, that only should be charged as a loss in your income statement. So, from $40,000 to $50,000, that upward revaluation was accumulated in your revaluation reserves in the balance sheet along with the shareholders' funds. Now, you are making a downward revaluation from $50,000 to $38,000. There is a loss arising to the extent of $12,000. Out of this $12,000, 10,000 should be set off against your revaluation reserve, which was already lying, which will knock off that revaluation reserve. Excess loss of $2,000 should be charged to your income statement. However, if the amount of loss was not $12,000, suppose the second time when you made revaluation, from $50,000 the revaluation was made to $46,000, and the loss on revaluation which is arising only to the extent of $4,000, entire $4,000 will be charged as a loss against your existing revaluation reserve, which will not completely get eliminated. From 10,000 it is reducing to $6,000. It will continue to appear in your balance sheet under shareholders funds, that is under your equity, as revaluation reserve to the extent of $6,000, and no loss will be charged to your P&L. So you need to be careful when you are having the revaluation the second time or third time, means a subsequent first time revaluation is very simple. In case of gain, you create a revaluation reserve. In case of loss, you charge it to income statement as a loss. But when it is a second time revaluation and it is the other way, then you have to be careful. Let us now talk about the case of land itself for simple understanding, and let us now observe what if earlier there was a downward revaluation and now there is an upward revaluation. If earlier there was a downward revaluation, say you purchase the land for $40,000 and the value was changed downward to $38,000. So there was a loss of $2,000 which you have charged to income statement as your loss. Next year you find the value of the land rising up to say $45,000. Now from $38,000 to $45,000, it is rising in value by $7,000. The real revaluation surplus is not $7,000 because earlier you have already recognized a loss on that value by $2,000. So out of $7,000, $2,000 will be treated as a reversal of the earlier loss, which will be taken to your income statement as a gain. Reversal of a loss is a gain. Balance, which is excess beyond the value which was recognized originally, that excess is the revaluation surplus which will be taken to revaluation reserve, not via income statement but via the statement of other comprehensive income. All this is very, very important. What I have explained, you need to write it down systematically. That will be written under the heading effect of revaluation. So I am sure you have written this heading effect of revaluation, and under this heading you please write, if an asset's carrying amount is increased as a result of revaluation, the increase shall be recognized in other comprehensive income and accumulated in equity under the heading of revaluation surplus. However, the increase shall be recognized in profit or loss to the extent that it reverses a revaluation decrease of the same asset previously recognized in profit or loss, or you can call it as income statement. So please write up this much and then I take you ahead. Alright friends, once you have completed writing this much, let us continue writing further. If the assets carrying amount is decreased as a result of revaluation, the decrease shall be recognized in profit or loss. When I say profit or loss, it is basically your income statement. However, the decrease shall be recognized in the other comprehensive income to the extent of any credit balance existing in the revaluation surplus in respect of that asset. The decrease recognized in the other comprehensive income reduces the amount accumulated in equity under the heading of revaluation surplus. So please write up this last part as well, and with that we will be putting an end to this session.